Hello and welcome to another video. Saving money is a major challenge for many, primarily because we enjoy spending every penny we earn. Today, let's explore 5 tips that can help you save a significant amount each month. So, let's dive right in. I'd like to introduce my 3 friends, Bill, John, and Brandon. Bill is 25 years old and loves spending money. Like many of us, he doesn't save much because he has a steady job earning $36,000 after taxes, which covers his expenses including his mortgage, car, and a new iPhone he just bought. As time passes, Bill gets married and becomes a father. This means that now, in addition to his expenses, he must also support his child and possibly his wife, all while his salary has only increased by 15% over 5 years. Consequently, he needs to cut back on his spending to manage all necessary costs. Even though his salary continues to rise over the years, it doesn't keep pace with his expenses. After many years, Bill decides to retire, only to find that he hasn't saved any money at all, leaving him with no choice but to continue working. In contrast, John doesn't want to find himself in Bill's situation when he reaches his 60s. Therefore, he commits to saving 10% of his income. He hopes that by the time he is 65, he can stop working and enjoy his life. After 40 years, assuming a 3% annual income increase, he manages to save $264,385. While this may not be enough to travel the world and support his expenses for the next 20 years, it's certainly better than Bill's situation. Our third friend, Brandon, also 25, earns a similar income and realizes that saving just 10% will not lead him to financial freedom anytime soon. He knows that to see a significant difference, he'd essentially have to wait until he's 65. So, he adopts a different strategy. Instead of saving 10% of his income, he decides to save 25% and invest it in an investment fund. Like his friends, his income grows by an average of 3% annually. Assuming he invests $9,000 from his salary, despite his income growing each year, within less than 10 years, his savings exceed $150,000, $151,093.20. He can either withdraw this money to start his own business and perhaps retire early, or keep it in an investment fund, letting that initial $150,000 grow to $4.2 million by the time he retires. $4,246,087.11. Compared to Bill and John, Brandon will either be able to retire early or enjoy a fantastic retirement. What sets Brandon apart from the other two is his willingness to sacrifice 10 years of his life now so he can live however he wishes later. The first tip is to know specifically why you want to save in the first place. Many people give up on saving because they don't understand the purpose behind it. Your goal shouldn't be to save for lavish weddings or shiny new cars, as achieving those will only return you to your previous financial dilemmas. The ultimate objective should be to attain financial freedom. The second tip is to pay yourself first. Before even considering any spending from your income, set aside a portion into your savings account. Set one up if you don't have one. This money should not be spent under any circumstances, no matter what, but should instead be invested. Treat this saving like you would taxes, a mandatory expense regardless of personal preferences. The third tip, understand your expenses. If you're not accustomed to saving consistently, starting can be difficult, particularly in the first couple of months when you might feel your savings aren't growing quickly enough. Therefore, first get a grasp on your spending habits by noting every transaction for the next 30 days. By month end, you'll have a clear picture of how you allocate your money, allowing you to cut expenses in non-essential areas. For example, instead of purchasing coffee every morning, consider brewing it at home to save $50 to $70 monthly. Additionally, opt for public transport instead of driving to work if it's cheaper, potentially saving another $50 to $60. The fourth tip, delay purchases. While procrastination is generally viewed negatively, in this context it has its benefits. We're often eager to buy something new immediately, even if it's not a necessity. Over time, that initial excitement fades. For instance, after purchasing a new phone, the thrill lasts only a few days before it becomes just another item to gather dust. Cultivating the habit of delaying significant purchases can lead to smarter spending habits. Always use cash. Whenever possible, use cash rather than a debit or credit card for purchases, whether dining out or grocery shopping. Handing over a $20 bill feels more substantial than swiping a card, which can give the illusion of spending less. With time, you'll develop a more conscious spending behavior, leading to buying only what you genuinely need rather than what you want. These are 5 tips to help kickstart your savings. I hope you found the video enjoyable and informative. If you stumbled upon this video by chance, consider subscribing to more similar content and don't forget to give it a thumbs up. I'll see you in the next one.